Good morning, everybody, and welcome to the fourth core perspective of 2020. During the year, we've attempted to start asking questions that are a little bit more probing into how we go about doing things and why certain shifts within our industry is affecting our business models and how we can build models to some extent that addresses some of these. As a start, so let's look at do a recap of the perspectives of the year, where in the very first one, we specifically went and we had a look at what sits behind the shift in passive. And what we found is there's effectively four drivers. It's regulation, it is the market environment, it is technology, and it's the balance between informed versus uninformed investors. And as a consequence of a lot of skills being attracted to the industry over a 4 or 5 decade period, it's become a very difficult industry to actually prove skill and also be able to consistently beat market style portfolios. In that analysis, we basically went and we concluded in the end that not only have we seen efficiency in terms of underlying managers acting in the market, but we've also seen the fund selectors being able to pick those managers that have a slight edge. And so over time, what we found is that if you look at the asset-weighted returns of the market, that is broadly in line with what the market returns have been, meaning that after fees, because passive funds are much cheaper, they end up delivering better returns than most of these combination of active funds. And so in the second series, we sort of looked at, if you now accept the investment theory, and there's extensive academic evidence that the market is the ultimate multi-manager, where can advisors add value? And we went and we illustrated how difficult it is, and especially if you include investor behavior, to be able to achieve the necessary return objectives for clients. And so we showed two examples specifically in the retirement space, where we showed how if advisors focus on some of the important drivers, things that are quantifiable, that over time they can get better outcomes for the investors, rather than trying to focus on picking the next winning fund. Now, one of those recommendations basically was the importance of using higher equity funds within the post-retirement space. And then the question beckoned, but what about sequence of returns risk, which Tracy and Leonard covered quite succinctly in the third perspective, showing that it doesn't actually matter as much as people think. There is a investor behavior case for bucketing, but there are clear rules and things to consider. And specifically, one of the findings was that the first 3 years of retirement is really the critical period where you need to manage that investor behavior. And then after that, you really want the growth and ensure that the assets last. Today, we're really going to have a look at where advisors can add value and how they can get these clients to see their value add. Because we sit with all sorts of different focus areas and explaining concepts to clients, which are often complex, and so this is not an easy task. Now, I think as a starting point, we always have to look at the financial advisor's business model. So we've broken it up into 4 broad dimensions. The first part is the actual financial planning. So this looks at things like short and long-term needs, risk planning, estate planning, and tax planning. Then it is the allocation to the appropriate products. So this is investment portfolios, wrappers, offshore wrappers, etc., to try and get tax efficiency. And then the third part is the behavioral part. Now, one of the most important behavioral part is the incentives. And these quite often influence which products have been used, and over the past, in some cases, it has not necessarily been to the benefit of the client. The second part of that behavioral is actually managing the client and the advisor's behavior, which is also really important in terms of how that is included in that financial planning side. And then really the thing that underpins all of these is really the business model. So where's the remuneration earned? Where are there conflicts of interest? Then there are operational efficiencies that can come through proper practice management, and then of course outsourcing to appropriate partners. Now this business model, of course, has got a number of different, a number of challenges in the years to come. Now, there's some very specific SA risk that we've got a declining affluent base. Our economy hasn't grown. Of the existing clients, a lot of their beneficiaries have emigrated, and it's more likely that the assets would be lost over time. And then, of course, the big question of transformation. How do you transform your financial planning practice to be more reflective of where a lot of your future clients will be coming from? The second really important part is operational efficiency. So this is things like the rising cost of systems. Generally, systems are provided by international providers. It's priced in dollars, and so it can be quite pricey. Increased complexity and challenges, and this is mainly can be due to regulation, but also due to tax planning, where you require a lot of different moving parts to assess the appropriate course of action. And because of the complexity, there's of course also increased processing risk, that things fall through the crack and they're not implemented as originally intended. And then the last part, of course, is there's always regulation. So over the last few years, I think some of the key regulatory implications for advisors have been things like the default pre- and post-retirement, of course, which means that pension funds, occupational and employer pension funds, have to provide default pre- and post-retirement solutions, which has the potential to almost disintermediate the advisor from many future potential clients. And then the big one that's now almost like a combination of various different kinds of regulation is the new Conduct of Financial Institutions, COFI. Now, I am no lawyer, and for that reason, I've asked Liesel Momberg, who used to be our head of legal in the business from this month. She's actually now our Chief Operating Officer, to sort of explain to us what is the main intent behind COFI and some of the implications of it for financial planners. So, Liesel, at a high level, what is COFI and what is the intentions behind COFI?
Thanks, Yanni. Yeah, so COFI is definitely one of those pieces of legislation that shifts the conversation to how do you demonstrate that you're going to add value for the remuneration that you're charging. It mentions things like they can prescribe requirements for conflicts of interest, how you mitigate those. And previously, the RDR discussion papers, Yanni mentions that there can be guidelines on your remuneration structures. It's high-level principle-based at this stage. The devil will be in the detail in the codes of conduct standards. But be that as it may, what we do know is that it's all about unpacking advisor activities and really, for each activity that you're performing, showing that you are adding value and that value that you're adding are arm's length. Yeah.
Now, do you think this, because most legislation in the past, if you think of phase, etc., usually adds additional layers of reporting and regulatory requirements, which often leads to outsourcing some of the services. Do you foresee similar kind of things happening with the implementation of COFI?
Look, hard to say. The overarching consensus seems to be that it should be easier for advisors to meet their regulatory requirements because it's principle and outcomes based. So it sets high-level principles and outcomes, and sort of this principle of proportionality should make the cost of compliance cheaper. However, again, devil's in the detail, so we'll have to see what level of detail and what requirements are set down in the codes of conduct.
Okay, thanks. Now, one of the other considerations in this, or challenge that advisors face, is the perceived value that they add to their clients. And Morningstar did a really interesting study a few years ago that specifically looked at the gaps between where advisors think they add value and then where their clients think they add most value. And the three that had the biggest gaps between those sort of expectations and rankings were the ones on the screen. Now, the first one, which was no surprise to me, I have sat in a lot of financial planning practices over the years, is that most clients think that the advisor can help them maximize their returns. And that's effectively something that we covered in the first two core perspectives. And what the authors basically said is that for years, professional advisors promoted their services as a way to beat the market, which of course has stayed with clients, but now advisors have moved on to other kind of services and seeing other places where they can add value. And what the authors conclude is changing this return perception won't happen overnight. And it definitely hasn't. I mean, even where we are today, it took at least a decade from phase to start moving away from just purely being investment focused. The second one that was really interesting was that the one single service that an advisor can provide that will have the biggest impact on their client is actually the one that the client ranked last out of the 15 value-added or valuable services. And so clearly clients don't value helping somebody actually deal with their emotions during the market. And then related to that was the one that advisors ranked first, which they thought that understanding their clients is really one of the most important needs. And what the authors basically concluded was to say, even though personalization or behavioral coaching has a big impact on clients, most clients don't value it. And this is really one of the biggest conundrums for the advisors, and it's related to the business models as well. It is, how do you shift from this return-first mindset to a behavioral coaching and personalization? Now, what is also interesting is that the whole conversation around passive investing has been directly linked to that perception around that financial advice can beat the market. And that's why, if you look at this slide that I presented in the first and second parts of our series, that active versus passive, of course, was a very natural reaction from advisors when they were trying to promote their services as a return or market-beating performance. With RDR, or with phase, at least in South Africa, of course, the regulation, the transparency, and with passive funds building up track records, advisors has moved to the active and passive. But what we've seen, we still see some of the focus on these funds. And I mean, a lot of the funds have sort of become quite big because now they have a lot of passive and active funds in it. Which is why it's really important at this stage to almost like come to terms with what the real academic evidence has shown for a very long time, which is broadly that the market is giving you all the active views, both at the underlying fund manager level and at the fund selector level. And we showed that basically by saying that even at fund category level, if you calculate the asset-weighted peer return over time, before fees, you end up with the same return as what the market portfolio for that given category has delivered, which is to almost understand that the market is the ultimate multi-manager. You are already getting diverse views at a scale that is beyond anything that you can find in a single portfolio. And therefore, as a conclusion, is that advisors cannot really differentiate them via the investment models. There are different combinations of the same parts, but they're still subsets of what the market is. And so there has to be some form of common sense that is applied, in the sense that to say you're already getting all of those views. How you think about where your active and passive will work together is different than just chucking them together in a portfolio. Now, like with many things, there are like initial intent and then there are outcomes. What has definitely happened in the retail space is that we've seen significant over-diversification. A typical institutional solution for a large corporate rarely contains more than 3 balanced funds. Institutional asset consultants look after very, very large pots of money, especially the big 3. And so those individual holdings can be significant. If we look at the example on the screen, which is the largest balanced multi-manager fund in SA, where they have split out the domestic and the global portions, but you can see they've only got 5 funds within a 180 billion rand fund of funds. of which the average holding ranges between 11 and 31 billion rand. Now, those are not small pots of money, which is why once you get to that scale, you have to start looking at things like segregated mandates, so that if you do want to make a transition, you can't just switch out of one fund into another. You have to do a whole transition, etc. So the vast majority of advisor assets don't come near to, I mean, this is just for one risk category, never mind all their different funds. And so in most of our research, we found that you don't really ever need more than 3 funds within a specific risk profile. The other part, and this sort of comes back to the whole market portfolio versus individual funds, that really manager risk is taking an individual carve-out, an individual active manager's relative bets versus the market portfolio. The market portfolio, the only real risk you're sitting with there is the tracking error that is implemented in a cost and tax efficient manner. And so advisors are left with a very difficult mind shift. One that moves away from how things have been done, almost like structurally within their business in the past. And this is really like a shift from designing journeys where you can take the client on so that they can get to the aha moment and they can sort of realize, oh, this is why actually this is important. Taking all different kind of factors into consideration, not just the usual needs necessarily, but it may be things like their behaviors, like their comfort with risk, etc. The other part, of course, is now, we're talking about products and incentives, is that this also entails moving to systems rather than products. And those systems will include things like your compliance, your record of advice. It includes built-in systems to be able to deal with the consistency of the financial plan, and then that incorporation of those different risk models. Now, the reason why this is so difficult is sort of like best illustrated by looking at how the average financial planner actually do financial planning. So this is a report that was done by an American. It's called the Kitch's report. It's very detailed around the amount of money, the amount of hours that's spent on a financial plan, depending on the different models, whether it's a single advisor, it's a group of advisors, etc. But I thought there's some interesting takeouts here for this conversation. If you look at the chart on the right-hand side, you can see that most advisors, and this is the lead advisor, that generally may have paraplanners, etc., about 70% of their time is spent on client-related activities. Small portion on investment, small portion on administrative, actually a very small part on management. If you go and quantify some of this, is that the average planner works about 43, nearly 44 hours, but that 43% of that time can actually be delegated. And so these businesses aren't necessarily efficient. And it's partly the way that they evolve. As an individual starts a business, they have processes. Over time, as they get bigger, they add staff onto it, but they never really change how they do things. You see it when businesses get large, and actually where advisors step into executive roles, where they still end up doing more advisor-related work and less leadership and management work. And then the other component in terms of efficiency is really financial planning software. What the study found is 90% of advisors uses the software, but nearly half of them actually supplement it with all sorts of other tools. And then increasingly, for specialist planning, they need specialist tools as well. So none of their businesses are set up to be highly efficient. And this is where I think today we're going to have a quick look at how, at Net Group Investments over the past 5 years, we've gone about looking at some of the tools, some of the ways to get around these, to one, deal with some of the challenges facing advice, but also making it more accessible to more people. And the first place we looked to was the concept of mass customization. And this sort of speaks to that slide about the gap between the moving away from the investment side to the behavioral and the personalization. And so what mass customization is effectively does is that it personalizes the client experience, but it industrializes the financial service. So if you look at that pair of Nikes on the right-hand side, they don't go and take a pair of tennis shoes and then put a pair of running shoes uppers on it, because they were never designed to fit together. It was either designed as a running shoe or it was designed as a tennis shoe. But the client can go and personalize and express some of his preferences in that shoe that's already been designed for a specific purpose. And broadly, we need to start thinking about how do we create these kind of mass customized solutions to illustrate our value. Now, the first one, and I'm going to focus on the investment one for this session. In future sessions, we are going to look a little bit more at the planning and the behavioral side. But from an investment perspective, it's really important to get a framework within which you can design a number of different journeys. Now, that framework basically consists of short-term liabilities, long-term liabilities, and then long-term wealth creation. We've looked at taxes, we've looked at the ideal offshore exposure, etc. We looked at where do you want to make use of tax wrappers, etc. And that's all within that framework. Now one can go and build different journeys. If you do it by age, for example, it is somebody initially contributing to these three buckets, so initially just short and long term, and then at some point as they acquire discretionary wealth, they start adding it into the fourth bucket. But then in many cases, it's individual clients that actually comes to see, it's clients that go and see advisor for a specific role initially, and only later on the other components are built on. And so you also need journeys within each of those broad market segments. The second part is really to understand that you won't provide the same kind of investment journey for different kind of personalities. Now in 2020, we did a whole behavioural survey with Oxford Risk and a number of end clients with advisors and with advisors. And what we found, there were generally two main types of personalities. And we've sort of dubbed them the jumpy frogs. These are people that are very sensitive, or they're what we call low composure. They're easily unsettled by market environments. And then there are the people with high composure, which we almost call the nerds. And for each of these, there are different things that you have to focus on. If it's a skittish person, you really have to do scenario planning. You have to sort of take them and show them the different kind of possible outcomes to make them feel at ease. Now, for each of these, how you'll implement the portfolio will be slightly different. The implication of this is that you cannot have very complex, large investment models. And this is really where what market style portfolios really assist, especially in this mass customization, is that it takes a lot of complexity and duplication out of the system. Because you're already getting a lot of, you're getting all active managers' views effectively coming through, it allows you to simplify that value proposition. And the most effective way is to do it in a tiered manner. So to have what we call a default market portfolio, low cost, high probabilities of success. That is perhaps for somebody that's just started saving out. You don't want to go into too much detail in terms of servicing the client into portfolios and underperformance, etc. As the client acquires more assets, then you can start adding other alternatives. Within the Reg 28 space, effectively, we generally would not recommend more than 2 active funds be combined with passive, because you're already getting some of those views in the market. I would say maximum 3 if it is a large financial planning practice. And then, of course, there's a lot more scope for value add within the long-term wealth creation, which is really where most segmentation models focuses on high net worth individuals, where you probably have about 4 or 5 collective investment schemes in the client's portfolio. They may have shares as part of the remuneration. And then there's other investments such as owning real estate, etc., where advisors can assist their clients. So generally across the client's whole book, you're probably looking at a maximum of about 10 funds. So the client's book is diversified, but the way in which you achieve those solutions become part of a journey rather than just a solution. Now, Liesl, I thought at this point it's quite handy to get you in, because you've been quite closely involved in our My Retirement solution, which effectively is one of the examples of how this is done in practice. It's a specific journey. It's a specific journey for post-retirement. So can you unpack it a little bit for us and sort of explain to most of our audience how we came about developing it?
Thanks, Yanni. Yes, this was a fun project to work on, but also an eye-opening project. It was a solution that we designed, and it's, for me, a perfect example of what you spoke of earlier, of how we managed to democratize the financial service, but still provide a personal experience to the client. This solution was designed for people that are retiring and that are faced with, on their formal retirement savings, how are they going to, what would be most appropriate to take income for the rest of their life. Effectively, it's got 3 components to it. It's a warm digital solution. The personal touch is normally the financial planner that acts as the retirement coach with the retiree. You've got the digital tool that is typically the anchor that allows the client or the retiree to have those aha moments for themselves as to what are the options and what are the different trade-offs. And then underlying it all is the 3 solutions or income solutions that they can have for the rest of their life, one of which was a bespoke hybrid solution that we developed. How we developed this solution that may be of interest is every 2 weeks we tested with retirees, and based on their feedback, we kept on refining the solution until we were happy with it. I just want to your point, Yanni, of actually demonstrating your value add, this is one of the examples. If in the solution you were recommended our Living Annuity Plus product, this is one of the ways that we actually in the solution can demonstrate the value add. For example, if you were taking a 5% drawdown with this 65-year-old, female or male, you can see here, we can demonstrate how you can have 13 years of income longer than you would have had in a traditional living annuity. We can illustrate the lifetime value of the top-ups that we provide, as well as based on a 1.5% effective annual cost, the fee saving that you would actually get by utilizing the solution. And then similarly, another example on a 6% drawdown. Now, this we saw when the retirees were playing with the solution. I think there's a number of lessons that we learned. One was definitely this positive behavioral changes and buy-in that we saw from the client. First, it speaks to that default solution and the utter simplicity. We would, based on the needs that they've identified, recommend a solution, but the client would be allowed to play with it. And how we saw, the behavior that we saw, was it really anchored them, this recommendation, on what they were able to take. Starting out from, they all thought that they were super rich, and we saw some quite ridiculous income requirements. And then at the end of it, when they were played and they were editing, they actually came back to the proposal and anchored around that. Secondly, the opportunity that the solution also provide is, it was quite interesting from the retiree perspective. All of them sort of had a side hustle. All of them had plans for what they were going to do in retirement. And we see this solution, and personally, we use someone in our in Net Group Investments who is a retiree that acts as our retirement coach. So it provides this opportunity for longevity for someone in a practice that perhaps were retiring and can do this on a more full-time basis. And the same with young advisors coming in. And so from that perspective, it is also very nice that it provides a protection for you in your advisor practice, in that you can institutionalize the advice that's providing and sort of de-risk if you are worried about the consistency and the quality of advice that's provided in your practice. It's also what we would term a defensive solution against the threat of the default strategies, because now because you've democratized the financial advice, you can actually go and compete head on with the default solutions that retirement funds must present to their members. It definitely was a way to learn and play what worked in a warm digital solution. And we have taken that learnings again into the 2.0 version that we are working on. Lastly, I think it is, as I've alluded to, we've got a unique model that we've developed, or unique product that we call the Living Annuity Plus, as part of the solution, that we think is nowhere else in the market, and really helps to answer those questions of how can I make my income last longer. Yeah.
Thanks, Liesl.
Pleasure.
I mean, it's definitely been an interesting journey. And I mean, I think one of the key learnings I learned from being involved in our first digital advisor, Extraordinary Life, and My Retirement Solution, was that the importance of having the human involved. It's almost like, I think Donna used to call it high tech, high touch, is that you still need the person, but the journey that you provide through the digitally enabled advice is a far more effective way to anchor the client, and also to be able to deal with those 6 different kinds of personalities, because in MRS you can go and drill if you need to, and depending on the client personality you will go and drill into the specific thing that will resonate with that specific individual.
Jannie, you're spot on. We saw high levels of anxiety, and it's certainly not something that you're going to do with a digital solution only. So a lot of comfort provided by the advisors present, but then also the tool helped to anchor and see that trade-off almost into the future.
Yeah. And I think the retired coach was also something that resonated really with clients. It's like somebody that can have empathy, that's been through that process, that can almost put them at ease. And I mean, Kevin's been absolutely amazing at that. It's been interesting to see, and then also see how the referrals that's come about through that process. So yeah, I mean, I definitely think these kind of sort of like mind shifts lead to all sorts of other opportunities for an advisor practice. So just in conclusion, I think shifting the perception from returns first towards where advisors really can add value is really tough. And as I've shown, it's like both structurally in terms of how financial advisor businesses are structured, how they do things, how they charge for things, etc., all make it sort of difficult to actually go and apply the resources to start thinking of moving from a solutions and products a value proposition to journeys and system. And it doesn't have to be digital initially. Some of those systems can actually just mapping your advice process and identifying where are the aha moments, where are the points where if you can get the client to that specific point to sort of like see, oh, I now see why I can't do this or that. Some of that may be, I mean, in our case, we usually start off modeling on Excel and then from there onwards move on. And then, like we said, digitally enabled advice is an effective way to create efficiency. And I think these kind of tools are going to become more and more part of advisors' toolkits as we go into the future. Thanks a lot for your time, and I hope you have a good day.